Well, normally it's financial bubbles that tend to burst first, and a lot of people are already betting on that. So we are at record corporate leverage, corporate debt to GDP. Corporate leverage is a problem, and CLOs could be a part of the problem.
Please join us for our next live stream Monday, November the 18th at 9 p.m. Eastern. We'll go over current events, past guests, and of course, gold and silver news. Once again, our next live stream will be Monday, November the 18th, 9 p.m. Eastern. See you then. Hello again, everyone, and welcome to another edition of Silver Bullion Television, SBTV. I'm your host, Patrick Vieira. Once again, if you are new to this channel or you have not already done so, please do subscribe. Click on the bell to be notified on new updates, and do give us a thumbs up if you like what we do. We appreciate your support. Our guest today is Kevin Smith, founder and CEO of Crescat Capital, an asset management company that capitalizes on the most compelling macro themes to grow and protect wealth. Kevin has 26 years of investment industry experience, and he is the inventor of Crescat's firm-wide global macro investment process. And we are delighted to have him here today as our guest. Good day, Kevin, and welcome to SBTV. How are you doing?
Good, thanks, Patrick.
Great, glad you could make some time for us. You know, Kevin, ever since I started following Otavi Costa and yourself on Twitter, I gotta say that the economic data points that both of you put out, it really does demand a person's attention, and they are really warning signs of what is ahead. And the data in the form of these charts, they really do show the longer term trend and where we are at right now. And I, for one, appreciate the work that you both put into it.
Thank you.
Thank you. Can you share with us what convinced you to deep dive into this array of data points and the principle behind the model that Crescat uses?
Okay, so well, originally I have been using a quantitative fundamental equity model to score and rank 2,000 stocks, and I've been doing this for about 25 years now. And and we used it to launch a long short hedge fund, a long short equity hedge fund back in 2000. And then in 2006, I launched a global macro fund. And the themes that we developed, the macro themes, originally came out of the equity model. And for years, I've been wanting to build more of a macro model, and honestly, just never really got around to it. And about 2 years ago, Tavi Costa here really took the ball and ran with it in developing this macro model. And so it uses a lot of the same principles for scoring and ranking different factors that we use to score stocks, and now completely different factors, but the same type of system to score macro factors.
Yeah, I guess one of those factors is always the human factor, and human behavior. It's a major. It does have major impact on economic data, and often the patterns in human behavior, they can be forecasted. For example, when interest rates are low, people will be more willing to borrow than when rates are high, and when jobs are lost, people, they're not inclined to be spending so much on luxury goods. How does Crescat factor in the impact from patterns of human behavior in its forecasts?
Well, that's an interesting question. I think that in our macro model, I would say we have really three different types of factors in there that would take into account human behavior. And I mean, for us, the most obvious ones is the valuation factors. So when valuations for the equity side of things, at least for the overall market, are at an extreme. That's an extreme on one end or the other, whether it's greed or fear. Overvaluation or undervaluations create opportunities there to measure greed and fear. I'd say that the VIX is another indicator we have in that model that measures fear or greed. VIX being very low today, kind of bumping up against the bottom of a upward trending kind of trend line over the past year or two. it would be a sign of greed today, or complacency, if you will. Consumer confidence is a factor we have in the macro model that's actually a contrarian indicator. So when consumer confidence is really high, like it's been recently, that's that's kind of a greed indicator, somewhat, and one that we score, to help us time the top of the cycle. It's a little bit backward looking, so to get that forward looking edge on consumer confidence, you want to look at the some of the subcomponents of the Conference Board's indicators, which is the consumer confidence expectations versus the present situation. And when you see that expectations start to slip, then it's been an uncanny indicator for the peak of a business cycle virtually every time.
Okay. Yeah, recently Jay Powell, Fed chairman, he said that the current monetary stance is likely to remain appropriate as long as incoming information about the economy remains broadly consistent with their outlook of moderate economic growth, a strong labor market, and inflation near our symmetric 2% objective. Why do you think the Fed is so hell-bent on getting that 2% inflation target?
That's an interesting way to think about it. One thing that we're seeing is that inflation expectations are at close to 40-year lows, or really at 40 or 50-year lows right now. I think the University of Michigan came out with an indicator showing it at 50-year lows recently, and it's around 2.5% and yet when you look at median CPI, which is actually at 10-year highs right now, and so I think that during the global financial crisis we had trouble obviously generating inflation. We generated a reflation of asset bubbles in the financial markets. The inflation that everyone was expected never came, and so we've had just this ratcheting down of inflation expectations that's been going on really since the peak of inflation back in 1980, and why do they want to get inflation up? I don't think they're going to have a problem getting inflation up this time around, because there's just too many people on the other side of the boat. And it may not be something they really want to wish for. That's just my view.
Yeah, okay. Agree with you there. Winston Churchill, he once said, those who fail to learn from history are doomed to repeat it. And as you touched on a bit, the 2008 financial crisis, it took the financial world and regulators largely by surprise, and it brought the financial system to its knees. So looking back at 2008, what data would have screamed in capital red letters, red alert in the months before the crisis hit if Crescat's macro model was applied back then?
Okay, well, we have about 16 factors in our macro model, and how we designed it. And this was really Tavi's lead on this was to look at some of the macro factors that worked in past business cycle peaks as well as business cycle troughs. And not every cycle is going to be the same, and so some indicators are going to be different. I mean, one indicator in our model that was flashing red in the 2007 timeframe was there's about 3 or 4. The yield curve inversions were one of them. That's a pretty consistent indicator across all business cycle peaks. Actually, that one is very consistent. One that was kind of unique at that time was the personal savings rate being very low and contributing to the housing bubble, of course. The Fed hiking rates late in the cycle, so we have a 24-month lag where we look at rate of change of Fed funds. And normally when the Fed is hiking interest rates and it's late in the business cycle, we had that same kind of set of hikes which also corresponds with the yield curve inversions because it leads to yield curve inversions often too. But so that 24-month rate of change, there are probably a few other factors that I'm forgetting, but there were three or four back then that were really screaming at us, and those were a few.
Yeah. Okay. Yield curve inversion, is it still signaling a crisis ahead?
Definitely. We have Tavi built a model here where he looks at percentage of yield curve inversions within the Treasury curve, and there's like 44 different yield spreads from Fed funds all the way out to the 30-year. And what we found is that when more than 70% of the curve inverts, you get a recession every time, and it worked in the last 6 recessions with no false positives. And the recession comes within 2 years every time. And 2 years is kind of the outside time frame. It can come as soon as right away. Very similar to kind of the 3-month and the 5-year, or the 3-month versus the 10-year part of the curve, which also has an uncanny ability to forecast recessions. And so on both of those measures, we hit over 70% of yield curve inversions several months ago, and now it's come back down to around 46% or something like that. So, but it's when you go over that's the signal, and it works it has worked every time. I know this time could be different, but we don't think so.
Kevin, I also understand that you're of the view that we have several bubbles, otherwise referred to as the everything bubble, in the global economy today. Are we facing a crisis on the scale of the 2008 financial crisis in the months ahead, or how, do you have any idea how long this runway might be?
We've been in the longest economic expansion ever at this point, and we are at truly record valuations for U.S. equities. We also have a record global sovereign debt bubble with, I don't know how many trillion it is now of negative yielding bonds around the world. And so the extent of this crisis compared to 2008, it's hard to forecast that, but we think it certainly could be as severe, as significant. When it comes to the equity market correction, we have 8 different valuation factors that we look at to score the valuation of the overall market here in the U.S., and it's in the 100th percentile for the most overvalued that stocks have ever been. So 50, what that means that we could have a 50% correction in stock prices just to get to long-term median valuations. And normally when you get into a bear market, sometimes, but not always, does the pendulum stop at the median? So it could be worse than what we saw in 2008. But we're not necessarily forecasting that. We are forecasting a bear market for stocks that will in the U.S. that will lead to a recession.
Let's say we are heading into some sort of a crisis coming up. What do you see as perhaps one of the triggers that might bring it on?
Well, normally it's financial bubbles that tend to burst first that lead to the recession, and what might bring it on? I think an equity correction could bring it on. I think perhaps rising inflation that takes people by surprise, and maybe it's a late cycle type of an inflation that hits first, could start taking people by surprise. And and we've seen when you've seen this risk parity trade become very crowded and popular. Long stocks paired with long leverage bonds. A lot of big hedge funds are doing this trade, and it's the idea is that, well, your bonds are going to counterbalance. They move, they're non-correlated, and so when your stocks are going down, your bonds are going up, and vice versa. And yet, if we get inflation, actually this time around, it's negative for both stocks and bonds, and that could be a disaster type of a trade. So it could, it's something kind of out of the blue almost. That's not that people don't recognize as a bubble that goes wrong. The negative yielding interest rates. I mean, everyone. Not everyone, but a vast majority of people, I think, believe that when we get into the next crisis here, that we're going to negative yields in the U.S. And a lot of people are already betting on that here in the U.S. And what if we get a different type of what if we have inflation instead, and the Fed can't cut rates because of that.
Collateralized debt obligations, CDOs. They were a major contributing factor to the troubles of 2008, the global financial crisis. And today we have something similar called collateralized loan obligations, or CLOs, and they seem to be pretty popular with the financial markets. Are CLOs posing a threat to the financial system today?
Well, in general, when you talk about CLOs, you're talking about corporate credit and subprime corporate credit, and so when you look to the overall corporate credit imbalances here in the U.S., we are at record corporate leverage. Corporate debt to GDP, non-financial corporate debt to GDP, for instance, is I think close to 75% to debt to GDP here in the U.S., which is a record all-time high. In the global financial crisis, the problem was personal debt, was household debt to GDP, hitting all-time highs in the housing bubble. So corporate leverage is more a part of the picture here in the U.S. And and we're also seeing concerns about credit rating agencies, pay to play, or pay for your rating among the issuers. Again, the same type of problem that we had during the mortgage crisis back in 2007. And so it's possible, and it's not just CLOs that are these securitized instruments now for corporate debt, but also there's commercial mortgage-backed securities and other structured credit that the corporate leverage is a problem, and CLOs could be a part of the problem.
Kevin, the reason I was asking about CLOs was because the IMF, they wrote in a recent blog post that corporations in 8 major economies are taking on more debt, and their ability to service it is weakening. And their conclusion was pretty sobering, where debt owed by firms unable to cover interest expense with earnings could rise to $19 trillion. So given that corporations underpin the equity markets, which are still at pretty heady highs, I think we just had another all-time high. Equity markets, are they in a high-risk position right now?
Well, absolutely. We talked about the valuations already. I think you're also really starting to see the momentum of the stock market really peter out. And when you look at breadth, stock market breadth is faltering, and so the indices are making new highs. There might be some rotation underneath the scenes, people trying to swap out of growth stocks into value stocks. But what's really the wisdom of buying cyclical oriented value stocks at the peak of a market, of a business cycle, just because they have lower multiples at this time? And I think that there's a tremendous amount of risk in the stock market today, and it looks to me like the market is very toppy here.
Commodities, they've been more or less down the past few years. How do you think they're going to do?
The outlook for commodities, we think is extremely bright. When you look at many of the commodities to equities type ratios, we're at record lows for commodity prices versus stocks. The problem is when you get into a recession and economic demand falters, and that's bad for a lot of commodities, whether it's oil or base metals, and particularly with our views on China, which are pretty bearish given the extent of the credit bubble there and the downturn that we believe that they are now in. We're not particularly bullish on oil or industrial commodities, but for us, the outlook, first and foremost for commodities, we think that precious metals will see the initial boost from rising inflation expectations and from the haven demand in an economic downturn. And when you look at the precious metals indices versus stocks and precious metals mining indices, for instance, near record all-time lows and just starting to break out to the upside.
Given that gold has been in bull markets in the past, has Crescat also researched the data and come out with a forecast of how long this new bull market in gold might last?
Yeah, that's when you look at different gold bull markets in the past, we were on a gold standard for much of U.S. history. So we had the first gold bull market was 1932 to 1933. It lasted 1 year, and it was about a 70% rise in the price of gold. Most people couldn't participate in it because the government took your gold away, and then they revalued it up higher. But since we went off the gold standard in 1971, there was a 10-year bull market for gold where I think it was up something like 2,300%, and then we had a 20-year bear market. Then we had another 10-year bull market for gold from 2001 roughly to 2011, and I think that was like a 600% plus bull market. So the last two bull markets have been 10-year kind of bull markets, and this one started already really at the end of 2015. We had an initial big spike in precious metals mining stocks in early 2016. That's consolidated quite a bit, and now gold and silver mining stocks are starting to move up again, as is the underlying metals. So we're already a couple years into this new bull market, 16, 17, 18, 3 or 4 years into it. But if you look at those last two kind of 10-year bull markets, that could be a good gauge, because this base, like I just said, has been building for like 4 years already, and it looks. It could happen sooner, but I think we have. You just look at the past cycles; they're all a little bit different, but 10 years seems to be kind of the average most recently.
How undervalued are gold stocks right now? Are they a good asset to consider holding given the recession expectations?
We talked about stocks being record overvalued at large. The gold mining stocks are the cheapest that we've ever seen them, relative to expectations for actually positive free cash flow, believe it or not, among a number of mining stocks, and the lack of capital investment across the whole sector during the bear market from 2011 to really to very recently has caused a big shortage of gold production out there, and so that there's really a sweet spot in that sense.
Wouldn't be doing my job if I didn't ask you about silver. What's Crescat's outlook for silver?
We're extreme. When gold gets into a bull market, silver gets into a bull market on steroids. And when you look at the gold to silver ratio today, near an all-time high, around 84 to 1. But when you look at the supply of gold versus silver in the ground, in the Earth's crust, silver is about 19 times the abundance of gold. So about 19 to 1 is really where that gold to silver ratio should be long term. We've been below that really just once in my lifetime, and that was in 1980 at the peak of the bull market back then. But we went to 16 to 1. So it is possible. When we were on a bimetal standard, it was down, and I forget exactly the ratio, but something like 17 to 1. There's 400% plus appreciation just kind of built in to get up to that 19 to 1, ratio versus the 84 to 1 that we are today. Silver versus gold, and so we like silver. We like silver mining stocks. We like gold too, but we think silver has much more leverage to gold.
A number of our guests on the show, they have the position that the Fed is unlikely to consider the implementation of negative interest rates. Do you follow that same view?
That they're unlikely to consider it. I think I wouldn't necessarily say that the Fed is of that posture. It seems to me that now that Powell has already, he says he's not doing QE, but just in the past 2 months, almost $200 billion worth of new money and monetary injection into the system, whatever you want to call it. I call it money printing, I think what would cause them to truly not consider negative interest rates would be if there actually is inflation really starting to show up, and so the crisis hits. But they can't hike. They can't cut rates. And so that's that would be the reason why. But I think the overwhelming consensus has, and I do believe we're in a sovereign debt bubble today, is that we are going to be headed to negative interest rates in the next recession. I believe that's more the consensus today, personally. And this idea of inflation expectations being near 50-year lows is kind of supporting that. But if we start to really see that picture change, then the Fed's really going to be between a rock and a hard place, and I don't think we'll see negative interest rates.
Okay. Yeah, the Fed's been telling us they've been taking securities off the hands of the banks in order to get them some liquidity. But is something else really going on, in your opinion?
Well, I do believe there is a liquidity crisis. There was a repo crisis, and interest rates. Banks failed to step up to deal with this funding gap, we have $1 trillion government deficit here, and we already did fiscal stimulus with the tax cut. So this is a rare time where we're at the peak of the business cycle and already have a large fiscal deficit, almost 5% of GDP. And I think what happened was that there was some kind of lending crisis, there was some kind of liquidity crisis, and banks were failing to step up to meet it. So Powell had to step in to provide that extra liquidity. And this is just another sign that we're nearing the peak of the cycle. The same thing happened in 2008 when the TED spread blew out, but now that we've started printing money again, the game is changing.
Yeah, I hear you. Kevin Smith, before we wrap up, can you let our listeners know more about your work at Crescat Capital?
Sure. At Crescat, we're a global macro asset management firm. We have 2 hedge funds, a global macro fund and a long-short equity fund. And we have a long-only equity strategy as well as a precious metals long-only strategy. Precious metals mining stocks that we have. Those are 2. That's an SMA as well as the large cap. We are determined here at Crescat to capitalize on what we believe is the peak of the business cycle, and to capitalize on a tactical downturn in the stock market here in the U.S. And so our 3 major high conviction themes that we have and that we express in our global macro hedge fund. Right. It's really a short Chinese yuan, play. We're short the both Chinese currencies, the Hong Kong dollar. We think there's a likelihood of a deep peg there, as well as the China yuan, and we are. We think China's the largest credit bubble the world has ever seen. They've created over $40 trillion worth of debt in their banking system, and anyway, that's a key global business cycle element to what we're seeing here, and we have a long precious metals theme. That's really the second major theme of the three, and then the third is a short U.S. stocks. So in our global macro fund, we're expressing all of those trades, and that's what we're doing here at Crescat today. And you can follow both myself and Tavi on Twitter, and it's Crescat Kevin. It's at Crescat Kevin and at Tavi Costa. And we have a website. It's an open website. Unlike a lot of hedge funds, we actually do make our research available to the world. And so we encourage you to check it out at crescat.net and follow us on social media.
Yes, we will. We will follow. I think you guys have some of the prettier looking charts out there.
I appreciate it. Thank you.
That was Kevin Smith, founder and CEO of Crescat Capital. For more of his insights on the global economy, please visit www.crescat.net. If you like this video, please hit the like button and subscribe to the SBTV channel to be updated on new content. And do also check out the SBTV podcast on iTunes and Spotify.